Welcome to yet another informative episode of Propfirm Trades, where we teach you everything about trading. So in this episode, I want to talk about how to avoid trading losses. It's not difficult for you to eliminate losses totally, but what you can do is find yourself at a position whereby you're more profitable than you're losing. Thus, you are able to compound and actually increase your trading account. So today we'll talk about analysis, market structure, psychology, trading checklists, your journal, plus your CE. So first and foremost, you need to keep it in mind that trading carries a risk, because when you're trading, you are actually risking your capital, you're risking your equity, you're risking your hard-earned cash. So you need to minimize that risk. You have to have more winners than you are having losses. So one of the things that you have to do is you need to have a mindset that will help you win, a mindset that will help you not give up, but a mindset that will help you realize that you are at such a stage in your trading journey, and you will realize that if you are still having more losses, you need to go back to the drawing board and be able to say that you need to learn some more, you need to refine some things, you need to reflect and see where you're going wrong so that you can correct that and be able to get to a place where you're winning. So we're here to help you have more winners than losses. First of all, when you open your charts, if you want to minimize losses, you need to analyze the market. You need to do a top-down analysis from the highest time frame to the lowest time frame. You need to check out your candlesticks. You need to check out their momentum. Are they small? Are they big? What are they saying to you? Every candlestick and every chart pattern actually speaks volumes, actually speaks about the direction of the market. So as you're doing your top-down analysis from the highest time frame, monthly, be it the weekly time frame, daily time frame, hourly time frame, and down to the minute time frame, what you need to be doing, you need to be drawing trend lines. If it's a trending market, whether it's going up or whether the trend is going down, you need to be able to see the market structure. And also you need to know, after you see the direction of the market, you need to know how price is behaving at support areas and at resistance areas. So as you're doing your top-down analysis, you need to mark your resistance zones or your support zones from the highest time frame, because price actually behaves differently when it gets to those zones. Maybe we'd want to see an example like on this chart. When I open this chart, the time frame, maybe let me open this one. The time frame is from this one, 24 hours. That's the daily time frame. I have to look at price and see if I can spot market behavior at this point in time. So I can connect highest points where price reached. As you can see, there's my trend line there. I'm seeing that market previously was going down. Then I want to mark the lowest points where market turned. Price reached here and went up. I want to mark all those points from the highest time frame. Price, where price just turned, because those are important areas. And then I'd want to see how price behaves when it gets to that point in the market. Also, I want to see if there's a trend where market is right now, where the price is right now. So that's what I'm getting from that time frame. You can go down to the 4-hourly and see if you can spot anything that can help you enter the market. Even as you're doing so, you need to check the momentum of the candlesticks. You need to check the patterns that the candlesticks are forming. That will help you enter the market. You need to check for dodges, for engulfing patterns, for graveyard dodges like this, and how market is behaving. As you can see, that's a nice place where price just came and turned. We'll have to draw a line there so that we see whether price will come back to that same place. Also, you'll want to extend your line and also go back and see to the left how the market was behaving, how price was behaving, things like this. You need to take note how price moves. So that's your analysis. That's how you analyze the market so that you can actually be able to see where you can enter. So after you analyze the market, you realize that you will see trends, whether it's trending up or it's trending down, or you will see whether it's ranging, it's a sideways market, or it's a choppy market. If it's a choppy market, you'll need to stay away. A choppy market is like this one here. This place here. This whole place, this place. This is a choppy market, this one. You can see that there's no safe direction, it's just noisy. You can't get where you're supposed to get in or where you're supposed to come out. And this is a trending market right here. This is a trending market. Trended down until price broke through from the trend. And here, market was trending up. From this point until price, you can see, let me try and remove this line so that it's actually clear. I have so many lines, may not be clear. You can see that the market was trending up until price broke through and it retested and came down. This would have been a great entry point. And then let me see if I can get a ranging market. Let me try and see from a lower time frame, because a ranging market is when price reaches the top, comes down, reaches the bottom, goes up. It's more like it's moving sideways. Okay, for a time here, market was ranging. So let me mark this one so that price went up. Price was up here, came down, went up there, came down, went and then went up. So at this range, price was moving sideways until it broke through. So you can see that it's easy to spot the market, what it's doing. It's easy to spot your structure. So in a trending, you trade when price touches the trends and the other confluencing factors as well, like support and resistance. In a ranging or sideways market, you trade at the support or at the resistance and get out at the opposite side. Choppy or noisy market, you leave it be. And your trading strategy, are you trading with a trend? Are you trading against the trend? Or are you trading pullback? Whatever it is that you're trading, practice proper risk management. After you see your market type, it will be easier to employ a trading strategy and practice proper risk management so that you can trade retest to trend lines or retest to support or resistance areas where you're trading chart patterns. Whatever trading strategy that you employ, practice proper risk management and know your exit points properly so that you do not make any mistakes and so that you do not have any losses. So one of the ways that you will minimize losses when you are trading is your trading psychology. So first of all, your trading mood. What state are you in? Are you overly excited? Are you having an emotional roller coaster on that day? Are you sad? Are you depressed? What mood are you in? Your mood will determine your wins or your losses. So if you're just emotional, I suggest you close the markets and stay away until you're stable and you're steady. Neither too excited, neither too sad. You need to just be stable and steady. So your trading mood also has a lot to do with how your account will fare out. So be able to trade in a stable and steady mood. Your reasons for trading also affect your trading. Are you trading because you have a valid setup that you are actually seeing in the market? Trade. Are you trading because you are revenge trading? Because the broker took your money, now you want to revenge and you want to just place a trade so that you actually make back the money that you lost. Do not advise you not to do that, because once you do that, you will lose some more funds and you'll be more frustrated. You'd rather close and reflect and then wait for some time until you are better able to make solid decisions. Then you can trade. FOMO, fear of missing out. This should be one of the largest reasons why people have trading losses. Avoid fear of missing out. You're seeing a setup and you're afraid that it might move before you enter. So you actually place a trade even before the full setup is manifested, even before the full setup is played out. Don't do that. Wait until your full setup is valid. Wait until the market actually confirms that it's heading in a certain direction. Then you can enter so that you protect your funds and you do not lose. So the other thing that will help you not lose your hard-earned cash is a trading checklist. You need to have a trading checklist. You need to print out, or you can actually write in a journal, in a notebook, or on your software system, WPS or Microsoft Word, whichever way. You need to have a trading checklist. Your trading checklist should comprise of the following: your trade setup. So a valid setup, you actually write down the reasons that will cause you to enter a trade and to exit a trade. You actually state the conditions that have to be fulfilled for you to place a trade. And when you read that condition or those conditions, if you see that they are there in the market, if you tick the boxes and you see that it checks, the list checks, you can then place your trade. And for your exit as well, you have conditions that you exit at such a stage. When it's valid, you exit as well. Why it's important for you to write all these things down is because if you keep them in your head, you will forget. But if you actually write down, you will not forget and you will be able to trade in the right manner and also compound and not experience market losses. So you need to put in your setup as well the correct market structure that you'll be trading in, such that when you spot it and you spot your setup, you enter. Your SL, your stop loss. Your stop loss protects your account in case your setup is invalid. Tell you what, we are not the market movers. We are not the ones that move price. Our funds are there for us to just make wins and earn profits. So if you do not put your stop loss, you will be the liquidity if your setup is invalid. So for you to protect your funds and so that you do not blow your funds, put a stop loss such that if your setup is invalid and it's not going in your direction, your trade is taken out. And also put a TP, your profits. Where will you take your profits if your trade setup is valid, such that even if you had closed your chart, price gets to that place, it closes and takes profit. Your lot size. This is one of the reasons or one of the things that can actually make or break your account. Your lot size refers to your market positions. Practice proper risk management in your lot size setting. Trade 1 to 2% of your account, such that when your setup is invalid, you will not blow. Imagine If you put all of your account and trade with all of your account and your setup becomes invalid, what will happen is that you will lose your money, you will lose your funds. So for you to minimize losses, have a proper lot size in place. So one of the things that will help you as well not lose out on your trading is journaling. Document your trades. I'll say this again: document and document your wins. Document and document your losses, so that you can reflect and you can actually see where you went right and how you went right, and can actually see so that you repeat the right win later or the right trading setup later. Document your losses so you see where you went wrong, how your setup became invalid, so that you can actually avoid it later. This will help you make better trades when you reflect back and see what you should avoid and what you should go for, because the market repeats itself time and time and again. So if you document your wins, you will be able to duplicate that next time. But if you do not, it will be much difficult. At times it will be like you're starting all over again. And another thing that will help you not have losses is a CE. Study, have continuous education, study trading materials, school yourself, study about supply and demand zones. These are your resistance and support areas. Study market trends, market structure, and its effect on price behavior. Study price movement. Even if you're not trading, just look at the charts, just look at the market and see what it's saying and see the direction it's taking. It will help you be more familiar, and it will help you master these trends and these trades and these zones, such that next time when you want to trade and you open the market, you basically know what's happening and you can better predict the price movement. Another thing that will help you minimize your losses is back testing. Scroll left, see how price behaved in the past, see how your strategy played out in the past. Look at candlestick types, look at their momentum, look at their behavior relative to the market structure. Study these candlestick patterns, study these chart patterns, and study trading psychology. Be able to back test, be able to see how price was behaving. This will help you when you want to place your setups. It will help you be more familiar with your trading strategy. And in conclusion, don't give up. Trade another day. Don't lose your account. If your setup is invalid, remember, let your stop loss cut you off. Don't shift your stop loss to accommodate more losses. No, let it be closed. Let the trade close so that you can stay away from the market at that time until you're better able to trade a more profitable trade. Because if you close, you'll still have more money to trade next time. But if you blow, that's the end of your trading journey for that time until you refund. So from Propfirm Trades, here's to more profitable trades, and here's to better trading on your part.